Hello, everybody. Welcome to another Reuters Events webinar. My name is Dominic Grocott, and I lead the ESG projects here at Reuters Events. We've got another fantastic webinar for you today. This is the first time we're running on the Zoom platform. And a point of to note is that if you want to submit your questions, which I really recommend that you do, we've got a fantastic panelists today, so please do submit questions. Make sure you're submitting them in the Q&A box, not the chat box. That's all that I'm going to do today. I'm going to hand over to Jim, who's our guest chair for the presentation and for the discussion. Jim, if you want to introduce yourself and lead off from there.
Hey, thank you, Dominic, and I'd like to thank Reuters for hosting this event for us. I'd like to first start off by introducing our panelists, and I want to tell you that in terms of what you're really privileged today. All three of these people who will be speaking on our panel today have spent a long time working in the area of sustainable management, sustainable governance, and also in terms of sustainable investing. And they were doing this long before it was popular and long before it was in every one of the newspapers on a daily basis. And so first I'd like to introduce Aidan, who's the Chief Operating Officer of the International Council on Mining Materials, and his focus has been on environmental issues. And Aidan's career goes back all the way back to the early 2000s, where he worked in terms of areas of climate, environmental issues with the World Bank. So welcome. And then next I'd like to introduce Schmitz Eulitt, who's the Director of Outreach for SASB, the Sustainable Accounting Board. And you know, she started her career, I'll be polite and not mention how long ago at Solomon, but then she quickly moved into focusing on sustainability and renewable energy, and in 2009 founded Resilient Consultancy to focus on sustainable management strategies. And last but not least, Bruno Bertocci, who's the Managing Director of UBS Global Asset Management in Chicago. And he's been their lead portfolio manager for global sustainable and equity strategies for quite some time. You know, he actually created Steinrow Global Capital Management, and I'm pleased to say that his bachelor's degree was in philosophy, so I'm just really pleased to have him here. My name is Jim Northey. I'm the Global Technical Committee co-chair for the Fixed Trading Community, which is responsible for electronic trading standards. And also, by way of that role through the US, I'm fortunate to be the chair of the ISO TC 68 Financial Services background. And to set the stage, so welcome panelists. Thank you for coming. And then, okay, to set the stage, I just wanted to talk about a couple of points really quickly. And in terms of one of the things that's amazed me has been that despite us being in a global pandemic, the likes of which we haven't seen since probably the 1918 Spanish flu in terms of the impact, you still see a continual presence and the topic of sustainable finance, focusing on environmental, social, and governance concerns has not gone away. I mean, the news cycle continues and is permanent. Just a couple concepts to throw out to the audience. John Kay wrote a book called Obliquity, where he talks about achieving goals or achieved indirectly. And the focus of his book was, as opposed to focusing on things like earnings per share estimate, you really ought to focus on core values for the customer, core values for society. And by doing so, you'll ultimately have a much better outcome over the long term in terms of investment strategies. And I think the work from McKinsey and other research have shown that. And the last thing I'll throw out there as a pitch is that I'm hoping that as we look at sustainability, we'll also start to look at the full life cycle of product development, and a really good source for that is a book called Cradle to Cradle that really talks about engineering all of our packaging and all of our materials so that they actually go through a process where we don't have to dispose of the waste. The famous article that was from the National Geographic on the amount of waste, especially in terms of plastics that's not reused. So so that just sets the backdrop that it just seems like the time is now for this. And what I'd like to do now is turn things over to Katie just to give a brief introduction on the SASB and also the efforts that were taking place for many years prior to the headlines starting to hit regularly on a daily basis on sustainable accounting standards and sustainable management. Katie, thanks.
Well, thanks so much, and thanks Reuters for having us. This is fantastic. It's great to be on an esteemed panel with Bruno, Aidan, and led by Jim. So thanks for the opportunity to tell you a little bit about SASB. We've been around since 2011, and in 2018, after quite a long while of standard setting activities, we issued a set of 77 industry-specific standards for the disclosure of ESG or sustainability performance from companies to their investors. So SASB's audience is specifically for corporates to communicate with their investors. So we like to say that we connect business and investors on the financial impacts of sustainability. If there are a handful of things that you think of when you think of SASB, one is that we are focused on financial materiality, issues that are likely to affect the financial condition or operating performance or market valuation of a company in a given industry. Our standards are market informed, evidence-based. They are designed to be decision useful for investors and cost effective for companies using them. So they are available free for download by any company that wishes to use the standards. We have a variety of other resources that are available. The standards on average have 6 disclosure topics and roughly 13 metrics per standard. So they're a very simmered down version of the entire universe of sustainability topics that a company could be thinking about or hearing about from stakeholders. But again, we are designed specifically for the investor audience. And then if you could go to the next slide, I'll give you just some overviews of, unless you're in PDF form. If you are, then it won't do this, the transition. But I can just give you some statistics that were on the next slide. So we often hear that SASB is just a US entity, only applicable in the United States, but over just about 60% of reporters who are using our standards to report are based outside the United States. References to SASB by companies who are looking at SASB in a preliminary stage, which is a leading indicator to when they'll begin reporting. Roughly 60% of those are domiciled outside the United States, and roughly 50% of reporters. I had those reversed. We have an investor advisory group. Bruno actually sits on that investor advisory group. Over 40% of our IAG members are domiciled outside the United States. We have over 100 entities who are licensing SASB into their own organizations to build their own ESG scores or analyses. Roughly 50% of those organizations are domiciled outside the United States. And nearly 40% of our standards advisory group is comprised of people who are outside the US. So we're quite an international used set of standards and organizations. So that's just a high level overview of our work.
Thank you, Katie. And then those are the numbers, they were there. So,
there we go.
Just to take a look at the breakdown in terms of this. And then what I think this is going to be one of those watershed years for the work that these folks on this group have been doing for quite a long time. We just saw that the EU released their sustainable financial disclosure regulation consultation paper on level 2 standards that need to be reported. And those are in line with the 2015 Paris Agreement, and then also the United Nations agenda. And it's by way of this United Nations Sustainable Development Goals that you see on the screen that I became involved in this as participating in the ISO standards. And in particular, the area of the ISO standards, which I helped to oversee and work in, is called ISO TC 68 Financial Services. And I think we'll allude to that a little bit later, because really what that is it's the infrastructure. It's the components, the identifiers and the messaging that actually drive financial services. And as such, I see us as having a responsibility to provide a service to help reporting on sustainable management, not to set those standards, but actually to provide the plumbing so that those can be fit in. So also, as part of this very proactive effort from ISO, they created a new group called ISO TC 322, which is focused on building a framework for sustainable finances, and that was created in 2018. That's led primarily by folks from the UK, and there's also involvement from people from China, which complements our existing ISO TC 207. You know, technical committees in ISO are made up of national standards bodies. And in the area of environmental management, we've had a very successful 14,000 series of environmental management standards and management practices. If you all familiar with ISO 9000 and a management standard practice, that's what TC 2007 brings to the industry, as well as defining green debt instruments. So that shows, and so I was very pleased being brought into this to have people who have been here at the forefront of this for years and actually have been working to develop the standards as we sort of see the ISOs and the more established infrastructure players start to pile on to a very, I would say, important area. So with that, what I'd like to do next, briefly, is to stop the share so people can see the panelists, and ask Bruno to just give his perspective as an asset manager about standards, sustainability, and finance, just briefly as an introduction.
Sure. So I think the evolution of the Sustainability Accounting Standards Board can be put into perspective if you think about how financial data became standardized, and this is something that we at UBS Asset Management are very focused on. So if you go back in time, and here I'm dating myself, but financial data 25 years ago was not standardized, and you had to gather data manually. It wasn't machine readable. And you spent, so if you're a global investor, you spend a lot of time adjusting data to make like for like. And that involved a lot of work. Mind you, if you're willing to do the work, there was an advantage to be gained from it. But what happened over time is the entity that standardized financial data reporting in the US was the Financial Accounting Standards Board, and that eventually became empowered by the SEC as being the standard setter for US reporting. And then later on, through agreement with global organizations, basically formed the backbone for global international financial reporting standards. And we see SASB as following along the exact same path, right? So we've got the SASB Materiality map, which is a fantastic set of indicators and all the reporting infrastructure around it. We see companies adopting reporting along with the SASB standards within the corpus of their statements. And we think in time that'll become the standard for ESG data. So we, as decision makers in asset management, would like a standardized framework. Obviously, that would be make it easier to use and more understandable, but it doesn't stop anyone from looking at the data today and utilizing it in investment processes, just as we did with financial data some time back.
Thanks, thanks, Bruno. I'd like, Aidan, you're from the ICMM and you represent the industry part of this, and I'd like to get some of your background on the value you see as somebody representing an industry association, one not always identified with sustainability, environmental goals, but just to get your aspect, and certainly your background going back more than 20 years in this area really speaks loudly to that. But I'd like to get some thoughts from you representing the industries.
Thanks, Jim. And sadly, it goes back over 30 years, which shows that you know, some of us have been in this area for longer than perhaps we care to mention. But look, thanks for the introduction. Big thank you to Reuters for organizing this. And just maybe firstly, for participants who aren't really so familiar with ICMM, we're an international organization dedicated to a fair, safe, and sustainable mining industry. We promote the concept of mining with principles to sustainably manage the natural resources of our planet and enhance the well-being of local communities. I guess, you know, unlike conventional industry associations, the sole focus of our advocacy efforts is on creating a responsible mining and metals industry and promoting the value of responsibly produced minerals and metals to society. So our 27 member companies account for somewhere north of 40% of global production of copper and iron ore, and about 30% of global production of gold, and fairly significant fraction of many other commodities. We've also got over 35 national and international commodity associations as members, and that really helps promote our work to the broader industry. But look, we engage in the development of standards in a number of ways. So firstly, we engage in processes that are led by others to develop standards. And some examples of this are the GRI Sustainability Reporting Standards, the IFC Performance Standards, and the UN Guiding Principles on Business and Human Rights. Secondly, then we co-convene the development of industry standards with others. And an example of that is working with the GRI on the mining and metal sector supplement, and a more recent piece of work we did with UNEP and the Principles for Responsible Investment to create a global industry standard on tailings management, which has been endorsed by all three co-conveners and will be published soon. And then thirdly, we sometimes lead on the development of standards with our members that they commit to, but that also represent good practice that the wider industry can then adopt. So examples of that would include position statements we've put out on climate change and Indigenous peoples, or on our updated and enhanced membership requirements, our mining principles, which define good practice, environmental, social, and governance requirements for the mining and metals industry through a comprehensive set of performance expectations. And these really seek to maximize the industry's benefits to host communities and minimize negative impacts to effectively manage issues of concern to society. And in part, they really respond to demands from investors, from customers, and other stakeholders that critically important raw materials be produced responsibly. So that's kind of the space we sit in when it comes to this standards area.
Thanks, Aidan. I appreciate those insights. Just to kick things off, I mean, it seems to me for most of the audience who are just probably trying to learn some of this and trying to get a sense of, we're just talking about really some quantifiable, comparable data, right, in standardized formats. And isn't that what is the key here?
Absolutely.
After you, Katie.
No, after you.
Well, I guess, yeah, it kind of really depends. So if we're talking about standards designed to report on ESG performance, absolutely, quantifiable and comparable data are important. But if the focus of the standards is on the responsible management of ESG issues rather than reporting performance, I'd argue that quality of management is really the critical factor. And often data can't be used as a surrogate for quality of management. So the equation that data times analysis equals insight often doesn't hold true when it comes to ESG data and how it's used to support investment decision making. Or if it does hold true, it's really hard to know, as the investment decision making process is currently such a black box. So investors rarely disclose specific details about their internal processes for integrating ESG factors into investment decision making. And the relative weight assigned to ESG factors is completely opaque. So personally, I'd love to see some level of standardization and standards development in this area. And lastly, the question of what level do you want to have comparable data for is also really important. Many investors will tell you that corporate level aggregate ESG data, whether it's through a GRI report or SASB disclosures, has limited value with the possible exceptions of carbon and safety. But I'd ask, what insights can you draw from asset level data for many important sustainability issues? It's really possible for a company to provide asset by asset data disclosures on water, biodiversity, human rights, without providing any confidence to investors that such issues are well managed at the asset level. And that's why for many ESG issues, I think we should be far more concerned about quality of management at the asset level rather than data.
Thanks. Any other thoughts? Bruno, do you have any thoughts on that in terms of the reporting? Yeah, if not, I'd like to just put the question that when I came involved in this, just by way of background a little bit, I've not been involved in sustainable finance until recently, but in terms of other areas of standards, starting in 2009, I worked with the smart grid, and then have been working with transactional energy on a personal level. I have lived off the electrical power grid for the last 10 years, and so sort of experiencing some of this at home. But I think it's fair to ask the question right at the outset. You know, can we really rely on the industry to set accountability and measurability standards for sustainable finance? Can we really rely on the industry, given what we've seen? I mean, and we're facing a cynical public, and and I think the pandemic has just exposed many fissures in societies at many levels of inequality. So I'd really, as people who have committed their lives to this, I'd really like to hear from you on that aspect of, can we really rely on the industry for proper reporting and then following through on these management goals?
I'll comment on that. Well, I think so. I mean, for example, the Institutional Advisory Group of SASB is made up of a very broad array of large asset owners and asset managers who are all dedicated to making good decisions in terms of structuring portfolios and picking stocks and bonds and achieving their rate of return assumption. So yes, I think so. And I think just as the Financial Accounting Standards Board did the task for financial data, SASB can do the same for sustainability data. Now, look, you know, even if you just step back and look at financial data, people can look at the same piece of financial data and reach a different conclusion about it in terms of decision making. So it isn't like just you have the data, you have an outcome. It places the functionality of the business model into a perspective where you can make your own independent decision about it. Valuation clearly has a role to play. And in financial metrics, I mean, this is back to my philosophy background, they're a metric that's produced by human activity inside the company. So, you know, if you look at days of receivables, you can look at that and then you can say, does the company do a good or bad job of managing receivables, and why? You have to look inside the company to understand that. And sustainability data is the same. You can look at the data and say, does the company do a good or bad job of managing their energy profile? Do they generate a lot of waste, and could they do better and improve their margins? You have to look through the data and you have to reach a conclusion about what the data means. But clearly, better data, more accurate data, more material data, more consistent data makes it easier to draw comparisons. And that's really what we're asking for the outcome to be, right? So it's really about developing a set of metrics that are reasonably consistent and that are reported by companies and their preparers that the investment community and the markets can make decisions from.
Any other thoughts or on that point from Katie or Aidan? You know, one of the other issues is can you really have one set of numbers across all industry sectors? It seems to me that it's really difficult when you're making investment decisions to how do you compare things across sector, or do we really need sector specific metrics as we develop these standards?
Well, I'll take that one because I think one of the things that really differentiates SASB from other standards that are available in the market is our industry specificity. So we have a strong belief that one size does not fit all. It doesn't make a lot of sense trying to compare companies in the services sector with companies in the mining sector, for example, on certain issues. So if you look at SASB standards, you'll see that we have a very tailored approach, and our standard setting process over time has really gone through the task of separating the wheat from the chaff, if you will, on these issues to show that the broad array across 5 dimensions of sustainability, which is how we sort of segment out the entire universe of sustainability issues, does not affect companies equally across industry. So I think it's a fool's errand to try to apply the same set of metrics across companies across the entire economy globally.
Yeah, maybe if I could come in on this point, I've got to absolutely support what Katie said on this. Look, I know that in ways the holy grail for investors is a simple and limited set of numbers, but universality really has its limits. And in late May, Jay Clayton, the chair of the SEC, cautioned against being too reductive about ESG when he warned that any analysis which combined separate environmental, social, and governance metrics into a single ESG rating would be imprecise, and it just wouldn't facilitate meaningful investment analysis. And so to get really specific, if you take something like greenhouse gas emissions intensity, the values are going to vary markedly between sectors. So it's going to look really different between the automobile industry, the electronics industry, mining industry, and pulp and paper. But even within a sector such as mining, emissions intensity is going to vary depending upon which commodity you're in, ore grades, ease of access to renewable energy, and a whole host of other factors. But at least within a sector, there's some level of comparability that's meaningful, even if you've got to dig deeper to understand what the numbers are really telling you. But in other areas like biodiversity, for example, how do you derive a universal metric or number that's meaningful even within a sector or even within a commodity group? A number of efforts are currently underway to try and do this, but most of these involve really significant levels of abstraction, and they draw upon global data sets to the point where you may end up with a comparable metric, but it tells you nothing of value that speaks to how a particular company understands or effectively manages its impacts on biodiversity. And what I think is much more meaningful is that companies have a clear narrative of why biodiversity or other ESG issues are a material risk for their company, how they either adversely impact or benefit from biodiversity in this case, where within their portfolios the greatest risks lie, and what are they doing to manage these risks?
That's great. Thanks. Thanks, Aidan. So I think what we're coming here to a conclusion is that the work, the foundational work that SASB has been doing, I think really shows the importance of cross-sector analysis, and it also doesn't take a naive approach of just assigning one number. But with that, there's a number of other industry efforts that are going on, and I was hoping that all three panelists might be able to comment on a couple questions that we've had come in from the audience. And one is, what's the difference between GRI and the SASB standards? Would somebody like to opine on that a bit and help the audience? And by the way, me being the person who offered to moderate this, so I could learn these things too. So Katie, would you like to take that one on the GRI and SASB?
Sure, absolutely. So GRI and SASB are both standard setting organizations. We serve quite different audiences. SASB's, as I mentioned, our sole purpose is to help companies communicate with their investors. GRI is a framework that many people use to communicate with a wide variety of stakeholders, including investors. But we have the specific purpose of providing a communication tool for companies with their investors, and it's our focus on financial materiality that has given us such a strong investor support base. So if you think of this from the perspective, and I've seen some of the questions come in about, how does this fit into the whole work that the EU is currently doing to take a look at the possible revisions to the NFRD. The EU has a very elegant framework for thinking about materiality that they call the double materiality perspective, where they're looking at both what investors are concerned about, financial materiality, and then other quote unquote sort of stakeholder materiality, which is focused on other issues that are perhaps not industry specific, that are perhaps horizon issues, if you will, things that we, through our standard setting process, have not yet determined to be financially material, but can over time become financially material. So there's an interplay, it's a dynamic system of materiality. And what you'll find in our standards is the subset of those other issues for which we have evidence of both investor interest in a topic, as well as evidence substantiating the likelihood that it will be, that it can have an effect on the financial condition, operating performance, or market valuation of a company in that industry. So that's the simplest way I can think of differentiating between SASB and GRI. But okay, they're both, because this is a complicated situation, as you've probably determined from the conversation we just had, there is no one single solution to all of the issues that every stakeholder is concerned about. So SASB and GRI jointly, as building blocks, provide a great approach for companies that are reporting to a wide variety of stakeholders.
Okay.
Yeah, I can tackle one question that I saw out of the corner of my eye, which is, what's the difference between SASB and the TCFD? I'm on the task force for climate-related financial disclosures, and TCFD is actually not a standard-setting organization. It is meant to provide corporates, pension funds, asset managers, and the like, a structured framework for considering how to assess, act on, and report on climate-related financial disclosures. And so we would say, for example, a company adopting SASB reporting would go a long way towards informing the public about climate-related financial disclosure. But it's really more of a how-to, a framework, how to embed these issues into a company's risk management practices, strategy setting practices, and it points to a variety of frameworks and methodologies for reporting on and assessing climate-related risk. So it's really got a somewhat different purpose, and it's supported by efforts like SASB.
So you'd say maybe the task force, the TCFD, would be more a consumer and a supporter of these various standards, and also helping the industry on how to understand and interpret and work with the existing data.
The TCFD has published extensively on how the risk management function within a company or a pension fund or an asset manager should consider climate risk. We published extensively on the subject of scenario analysis and a lot of other things that are really part of the process. A lot of the documentation is a how-to, and it's supported by all these external organizations and tools and so on.
That's good.
Yeah, there's a nice way of thinking about this and disabusing people of the often used mental construct of alphabet soup, which I often hear, is to think instead of TCFD, SASB, GRI, and others as more of a puzzle, and how does that puzzle fit together? And the framework, if you think of, if you do a jigsaw, the framework like TCFD, like integrated reporting, like the Climate Disclosure Standards Board, those are frameworks, as Bruno said, that help people think through IARC, think through long-term value creation. They're principles-based frameworks, as is TCFD, that ask you about the how. How are you thinking about these things? How are you managing? What is your governance? What is your strategy? What is your risk management? SASB and GRI are tools that help bring frameworks to life, that help companies actually describe what they are doing related to the topics that are suggested in those principles-based frameworks.
Thanks. Despite the existence of SASB and GRI, I still get many reports from the reference data space and firms that are actually trying to collect this data on behalf of investors, that it's really difficult to obtain this information. The information is very non-normalized, and the cost of trying to put together a picture is really difficult. And into this environment drops this ISO standard. And I'm wondering if an ISO standard, much like the 14,000 series, would help to improve standard reporting across globally. And I just want to get your thoughts on that.
Sure, I think ISO's strength is in harmonization. So ISO brings together, it's a platform that gathers subject matter experts from around the world to help refine things and to your point, help provide normalized data. So the standardized metrics allow measurement and improve transparency. That's comparability is something that we're all seeking to help provide. SASB, in fact, draws on ISO standards in many of our standards. So I think that what we're hearing from the market is the evidence of the immaturity. I think Bruno alluded to in some of his earlier remarks that we're on an evolutionary path, and compared to the journey that was taken to get us to standardized financial information. We're in very nascent stages of that journey, and SASB, drawing on standards like ISO and 200 other entities from around the world, really try to draw on standards that are widely used and that can help normalize data. So where we use ISO standards is predominantly in the technical protocol for SASB standards about how you would go about compiling the data. What does recycled material actually mean? We draw on ISO definitions in many of our standards. So there's definitely an interplay between those two things. So I'll leave it at that and see if Bruno or Aidan have any other comments to make without going too far down a rabbit hole.
Yeah, I mean, I guess I would say, look, ISO has a very important role in terms of, as Katie said, harmonization. I guess I think that the roadmap for ESG reporting goes straight through SASB, because I've seen it with FASB and it makes sense to me. And most asset managers, asset owners are very familiar with what happened with financial data. And we've got a very large and supportive group within the IAG. And we are also seeing that most companies are in fact global in nature. And so a significant portion of SASB reporting companies are actually located, headquartered outside of the US. I would say that there are some other things going on in parallel. I also sit on a working group of the CFA Institute for developing ESG standards for products. That's part of the global investment performance standards. And that's meant to help clarify, if you invest in a sustainable fund, what can an investor actually expect, and what are the standards in terms of labeling and process. That doesn't say anything about data. It's really more about process and product. And then you've got the emerging EC standards that are also about content in products. It doesn't speak to reporting or standards at all. It really says how much of the fund by revenue is concentrated in green activities, however defined by the EC. So this may seem confusing, but I don't think it's as confusing as it might appear once you get into it. If you think of SASB as helping decision makers put portfolios together and amplify what Graham and Dodd called the mosaic theory of investing, that's an easy way to think about it. And then these other standards are really meant to clarify, well, if I'm seeking a sustainable fund, what should be in it? How should it work? How it should be labeled? And then the EC, as part of the effort around sustainable development goals, is actively trying to steer financial capital towards green activities. That's actually something separate. It's a worthwhile endeavor, but it's separate from these things. So if you think about these as separate and worthwhile activities, then I think it starts to all make sense. And ISO, has been involved in standard setting throughout the industry for a long time, and I think it'll have a role here too. But I think underneath the umbrella of these other activities.
So specifically, TC 322 set out to be the financial framework for reporting. It seems more of the umbrella approach. And do you see some risks or concerns? I will say one of the good benefits of national of the ISO standards is they're supported by national standards bodies. We've used them within the financial industry to have cross-jurisdictional uniformity and consistency, which I think helps companies in performing their task. The other thing that I'll say at the offset, and SASB is a liaison organization to TC 322, is we've broadened the participation. But I think the question I would have for the panelists, when the TC 322 sustainable finance was announced, and our first work item is a basic framework. I was wondering what kind of reactions and concerns or opportunities you see from that initiative being started. which I think originated in both the UK and China.
So I guess I'm not particularly close to that process. I've been very close to TC207 back when ISO 14000 was first developed, I guess in the late 80s or early 90s, because I modeled the two between BS 5750 in the 80s and then ISO 14000 in the 90s. But I guess that going back to some of the beyond the kind of the data harmonization point, I think that ISO standards can help in a number of ways. So for example, your suite of management system standards complement more issue-focused standards. So, our mining principles, for example, they outline 38 performance areas that identify issues of concern to society that it's really important for mining companies to effectively manage. But the ISO management standards provide the architectural framework for systems that support protection of the environment or health and safety, but they don't necessarily determine the issues that should fall within them. And so I think there's possibly something there. And again, through that ISO TC 322 work on sustainable finance, I mean, I'd love to see that group focus on standardization of the investment decision-making process, which is currently such a black box. And as I mentioned earlier, you don't get much disclosure around the internal processes for integrating ESG factors into investment decision-making, and the relative weight assigned to ESG factors is pretty opaque. So I would love to see some standardization in this area. And the main reason I think we need much greater line of sight on how ESG issues are being integrated into investment decision-making is that, frankly, without it, I think it limits the potential of ESG to become a driver of responsible behavior on the part of companies. Until many more companies see demonstrable evidence that ESG issues are material considerations in the investment decision-making process, I don't see that happening.
Well, I would push back on that a little bit. So for one thing, if you're an active equity manager, which we are, we have our own analysts, we reach our own conclusions about what we think we should own in client portfolios, and the processes we describe at a high level, but we're certainly not going to disclose internal data, other proprietary assessments that we have. So if someone from the outside is looking for a complete transparency, they're not going to get it, and for good reason. That information is extremely valuable. We've worked very hard to get it, and we're making decisions based on it that's in line with financial theory and that yields an outcome. And our aim is to generate a risk-adjusted excess return. The inclusion of ESG data is really part and parcel of that process. We've decided what we think is material based on our own assessment and our own testing, and we include all of that information as we think is appropriate when we're picking stocks, or when we're avoiding stocks, or when we're shorting stocks in our long short portfolios. And as I said before, asset managers and individual investors can look at the exact same set of financial metrics and reach completely opposite views about a particular stock. So if you're looking for consistency, you're not going to get it. That's actually not how the market works. What I think is appropriate is for there to be a broad set of indicators that are largely harmonized. And I would point out that even in financial data, companies report the same thing in somewhat different ways. You still have to interpret it, right? And the preparers and the management gets to decide what's material. And one company may decide some metric is material, and another may decide the same metric is not material. So you still have to work that out. And still, I would say people can make quite good decisions based on the current array of financial data. And increasingly, they can make good decisions by incorporating ESG data. I like to call it material, non-financial data. And I think that really helps put it into context. It's really an extension of the information that we've always used to assess the value of a particular business and whether we want to allocate our clients' capital to it. But if you're looking for consistency and full transparency, You've never had it, you're not going to get it, and I don't think it's a reasonable expectation.
So here's the thing, Bruno, and by the way, I'm not looking for consistency, but I think, you know, there's this great asymmetry where on the one hand, the investment community say, we're looking for complete transparency and ideally complete consistency in terms of you providing data to us, but don't expect, you know, transparency in terms of how we're going to use that. And so, and I appreciate that the whole point about commercial confidentiality and the fact that you're not going to give away the trade secrets. But I think the difficulty is when I speak to investors and ask them about their processes for integrating ESG into the investment decision-making, into their investment decision-making choices, you know, their descriptions range from kind of art to science to alchemy. You know, it's so what I'm really looking for here is you know, can we have a little bit more reciprocity when it comes to transparency in terms of how this is used? Because I think that will ultimately help to drive more attention to this from the parts of the industry and the sectors that really haven't been so active in this space.
Well,
I think you can, sorry, go ahead, Bruno.
Most large-scale asset managers have investment presentations where they talk about how they integrate ESG data at a high level. We're certainly willing to talk about what we look at and how we do it, the details of which then are proprietary. But I don't think it is alchemy, frankly, Aidan. I think that that if you're talking to reputable asset managers, especially those that have pension funds as clients, it's pretty obvious what they're doing, in part because the pension funds wouldn't hire them if it was a completely black box process. There are quantitative processes that are in fact based on AI that look like black boxes to me, but anything that's handcrafted and involves humans has got to have a process that makes sense in terms of placing the data into hierarchy and in using it to reach decisions. Now, there are humans involved. Obviously, there are qualitative assessments that can't be boiled down to metrics, but that's part of the process too.
Katie, did you want to add, to talk about that?
Well, I think Bruno has said better what I was intending to say, but I'd also like to point out that there is such a wide variety of investment strategies and investment styles, active index funds, that to suggest that there should be a standard for how ESG is integrated into all of those processes, I think is, you know, a hill too high to climb. And I don't think it would yield the outcomes that you intend. I think having the conversation with investors about how they are and really digging into, you know, with honest inquiry about how they're integrating ESG into their investment decisions is the right conversation. But I think it isn't, I think trying to put a standard around that is not necessarily going to yield the results that you'd like. I do think that there is a black box related to ratings and rankings that is frustrating everyone. That's a different conversation.
We can't have that here?
Well, I don't think we have the right people to have that here, but I think Bruno would have a lot to say about that. But I think the black box really is the ratings and rankings, in my opinion. That's where companies are reporting data. It comes out in a variety of different, you know, the same company can be rated here, here, or here, depending on the ratings and rankings organization that you're subscribing to. I think that is perhaps where the focus should be in terms of trying to figure out what is actually going on in that black box. How are you taking the same information and coming up with such a wide array of results?
I think I'll spend a little more time with it if you. I think you brought up an interesting point. Is that we know that this similar to the financial accounting standards, as you said, we're just in the beginning days of sustainable accounting, and we have firms that go out there and do quite well with their ratings and rankings, you know, and selling those products, those aggregate products off to distributors. But the question is should there be some standards on how they actually go about reporting and the transparency around how they actually come up with their numbers? Is that an area where we could focus some attention in terms of approaches? Because, you know, it does have a significant impact, and quite frankly, I think it would be difficult to determine, you know, how those numbers are drawn now, seeing the difficulty in gathering them, I think. But let's take it from a FASB perspective. You know, even today, we have companies that, for whatever reason, misstate earnings. We still have accounting issues that arise. You know, how do we? And this was a question raised by one of our audience members. How do we verify? So let's assume we sort of unify and align around SASB principles, whether that becomes something recognized by ISO as an ISO standard, the SASB framework, which is one possibility. How do you verify? How do you really know what's being reported? It's very clear from an accounting standpoint what happens if you misreport. We have the Securities Exchange Commission. We have the Financial Conduct Authority. You know, we have the ESMA. We have organizations globally. So how do we know if there's any value or really, I would say, significant reality behind numbers that are being shared by companies?
Well, one of the importance of standards is to provide and to work with the accounting profession to ensure that there are suitable criteria for assuring that information. So that is why standardized data and standardized information is so important. So in all of SASB standards, we include technical protocol, which are a path to suitable criteria for assurance of the data. So that's, you know, we firmly agree with the stance that you need to have data that is of the same quality of that you would be providing your investors on your financial performance.
Yeah, let me say, I'll add to that to say, look, the value of SASB is in a way that it provides the company's accountants, preparers a framework for reporting the data. And we, as users of that data, have assurance that the accountants have checked the data and it's got reasonable accuracy, right? So that's part of the framework. But don't kid yourself. This is the most regulated investment market in the world, and the world's largest accounting frauds have occurred right here. So, you know, you're talking about World Scope, Enron, I'll give you a list. It doesn't save you from malfeasance if the management is determined to pull the wool over the investor's eyes. But obviously, a well-regulated framework with high-quality preparers will yield you better reporting and more accurate reporting than otherwise, and that's what we're looking for.
Yeah, just I mean, picking up on Katie's point around, you know, suitable criteria, it's there isn't a perfect read across between, you know, between the financial and the non-financial space. But I think, you know, we have worked, certainly, you know, when it comes to our members who don't report to SASB, they can, a number of them do, but they're required to report to GRI. And that's really, I think, partly it's an artifact of history. We've been around since before SASB came into being. And partly it's because we have a broader set of stakeholders that we think companies need to also provide information to. But for over a decade now, it's been an obligate requirement of membership that you've got to go through independent assurance of your sustainability reports. And that means that on an annual basis, you get an assurance provider coming in, selectively looking across a number of the material issues and doing a really deep dive from the macro level right down to a number of the assets to ensure that the numbers can be trusted. So I think there are ways of building credibility into the reported information.
Oh, that's good. Yeah, and Bruno, your point's well taken on malfeasance. So it just gives those folks some more numbers to work with, I guess. I just wanted to point out, just going back to something, Rebecca Healy, who's our EMEA co-chair for FIX, pointed out in the chat window that ESMA actually has a view towards looking at the ESG rating agencies and looking at regulating them and providing a certain level of supervision over the numbers they produce, which may hopefully have a positive outcome. But your point's well taken. Some other we've got some other questions that come up. Just one question was, will the UN SDG business benchmarks become standards? I think just speaking from an ISO standpoint, the ISO Central Secretariat is really pushing all technical committees to proactively address the sustainable development goals within their own standards. And if you think of the range of ISO standards, that covers everything from shipping container size to chemical composition, and Aidan can probably give you a list of 100 that relate to mining and materials. You know, having ISO push all of their technical committees, which are primarily made up of industry practitioners, to look at sustainable goals across every standard. I think that's how we move sustainable development goals into standards, is by proactively looking at every single instrument. And I know within TC68 we have but one sustainable goal that is tied to the legal entity identifier, which hopefully will help with transparency. But every group needs to be looking at that. So I think that's a very good point. I have just a question for Bruno, which certainly for any of the other panelists as well. How valuable are you finding alternative data sources or non-structured data in actually helping you to verify or analyze companies' the real essence of sustainable financial goals on a company, outside of just the sort of the standard accounting numbers?
Well, that's a super big deal at UBS. So we've got a whole team called the Quantitative Evidence Team that supports investment processes. It's really a team of data scientists and data experts that do work for the portfolio managers and analysts. And we look at everything under the sun: satellite data, we look at traffic data, all kinds of things that are helpful. Some are short, medium-term indicators. And then the UBS Investment Bank has Evidence Lab, which is arguably the largest effort on the sell side of its kind. It's a huge team of quantitative scientists, and we leverage them as well. So this is really part of this whole, what I would call an archipelago of data. We have an enormous amount of data, and we're sifting through it to help us make better decisions. I did want to loop back and touch tangentially on the whole raters issue. I do think that some of the questions that people have about the raters, I'm talking about MSCI, Sustainalytics, and the many more that exist, is wrong-headed. The way to think about what they do is the same way you would look at Wall Street analysts opining on a stock. I get my Bloomberg and look up a stock, I can find 20 different analysts that have an opinion about that stock. Some are buys, some are holds, some are sells. And I have to look through it and assess, well, who do I believe in? Who's got a good track record? Who's got a good process? Which of these narratives has substance, and make a decision accordingly. And I think people should look at the rating agencies in the same way. They're looking at this information and they're opining on the ESG characteristics of a company. And in about half the time they disagree with each other, and that's totally fine. That's the way the market works. And so expecting it to all come down to a single answer that you can just walk away with, it doesn't make any sense to me. That's not how any other part of the market works, and I don't know why you would expect this one to work the same way. Results will vary and opinions will differ, and that's what makes for efficiency. But I do think that the problem with it is that the average investor doesn't want to get into the weeds of thinking through, well, how did they come to this conclusion, and that they based it on things that I agree with or disagree with. But that's the key to good decision making. If you want it to be handed to you on a platter, you're not going to get there.
Very good, Bruno. Thanks. Well, we've come up to the. I think we're at the bottom of our half hour now, and I just want to thank our three panelists, and also want to thank them not just for today, but I think for 20 to 30 year commitment, realizing we're all on one one little small orb that's quite stressed at this point in time by a lot of people. So I really do thank you. And sorry we couldn't get to all the questions. I can say incredibly stream of chat going on at the same time. And you'll be able to go back and visit the recording later. So I want to thank everybody. And with that, any last thoughts or comments as we leave from any of the panelists?
Thanks for having us.
Yeah,
Thanks for
thank
having
you
us,
very
indeed.
much.
Perfect. Thank you, everybody. Thanks for tuning in today. We'll be doing another couple of webinars in the lead up to the 2 end-of-year events, one focused on North America, one focused on Europe. So next month, the webinar will be on unlocking S factors, so the social factors that have been somewhat less well looked at, should we say, than climate issues. From there, we'll be going to stranded liability, stranded assets. But you can see all this when I send you out the recordings tomorrow morning. But thank you to all our panelists, and thank you to everyone tuning in live. Thanks.
Thanks all.
Bye. Thank you.